In this week's update, money moving back to tech right on schedule. Opportunities are everywhere, working with the rhythm of the market, and we'll have a quick peek at the Bitcoin chart. My name's Garry Davis, and as always, this is general advice only. And please remember to like and subscribe to the video. Look, it's been a real roller coaster the last month or 6 weeks, but when you look back in hindsight and take everything into account, it really is just a normal periodic rotation that happens constantly, and it would be very unhealthy for us not to get some profit taking in the areas that have advanced the most, and that's the tech sector over the last few years. But we've now reached a better seasonal point. March, and particularly the last latter part of March, was always going to be seasonally difficult for tech stocks. But all the lights are really green now for pretty much all sectors of the stock market. What's been happening over the last 3 or 4 months, or really since November, I guess, when the vaccine was first came on the horizon, is that there's been an adjustment to different areas of the economy. The economy that had been most heavily hit during the shutdown from March through to the end of the year are starting to make a comeback. Now, some of them won't be sustained, but some of them will. And so the relative strength in sectors, the rotation that's been happening, is just a normal adjustment to a different economy. And as I said, technology has underperformed during this period, but I think that would appear that period of underperformance has completed now, as I sort of indicated last week. So what to expect from here? Earnings season is looming shortly in the US, and normally, particularly in the tech sector, you see a run-up in prices into the earnings results. What's happening here, and it's graphically evident when you're doing a lot of stock analysis at an individual level, is that analyst expectations are being ratcheted up very, very quickly in the last few weeks. It's easy to access data in the States, which shows you for any stock what the analyst estimates were 13 weeks ago, 7 weeks ago, 2 weeks ago, and current. And what I'm seeing in so many places is analyst estimates just having exploded away in the last couple of weeks and gone up enormously. So I think that is going to start to be reflected in share prices. Because at the end of the day, that's what drives share prices. It's earnings expectations in the first instance, and then if they're achieved, then that tends to sustain the price. Now, in this quarter coming, the results we're going to see for the March quarter, the quarter-on-quarter growth numbers are going to be absolutely eye-wateringly massive, because the first quarter of 2020 was, of course, very much COVID lockdown impacted. And so it's coming off a low base. So the percentage increases are going to be ginormous. Now, a lot of that is factored in, but there's still going to be companies that are going to beat expectations. And I'm seeing that, as I said earlier, because analysts just seem to be playing catch-up. It would seem that they've been lagging badly in terms of their forecast on forward earnings. So I'm expecting this period, which will start in about a week, to be a good one. And I expect the stock market response to it is going to be pretty good as well. And look, we're already in a situation where the S&P has just broken 4,000 points, and the Nasdaq has turned around, and really all parts of the American market are looking very strong. So the S&P ended up rising 1.2% across the week, breaks 4,000 points for the first time in history, closed right on its highs, and just couldn't look any more robust than it does at the moment. The Nasdaq rose 2.7%, so it outperformed on the week, had a strong finish, and there were a number of things that were against the technology sector in the last month. But I think they're all pretty much coming to conclusion, particularly, obviously, the seasonality side of it as well. And we saw that the response from the tech sector all of a sudden was quite different. And specifically over the last few months, whenever the 10-year yield went up even a tiny bit, even 0.05%, the tech sector would sell off dramatically. But what we saw was some ups and downs in the yield last week, but the tech sector seemed to be all of a sudden immune to the changes in the yield. So I think that's another interesting indicator. The US dollar is clearly continuing its uptrend. Took a little bit of a step back on Thursday night, but nevertheless he's back and to 93 and firmly heading higher. 10-year yield 1.72, which is not far off the highs. So things are ticking along there. And look, really interestingly, the VIX fell to 17. It was just hovering around the 20 mark, a bit above, a bit below for some time, but the VIX has just all of a sudden fallen away. So things are looking really good in the States. Let's go and look at some charts. And we'll start with, look, the Dow Jones Transports is always a great indicator of the real economy. And you've just got to look at that chart, whether you think the American economy should be going well or not, whether you think the debt is a problem or, whatever it is you might think, you've just got to look at this chart of the Dow Transports. And, it's like all-time highs, and look at what it's done since the March crash last year. It's just an extraordinary rise, and it's continuing, and it's very stable. We're only seeing just the odd day down here and there. So that tells you all you need to know about the American economy and therefore the American stock market in general. Now, there are a number of sectors that are doing very well, but none better than semiconductors. Technology is exploding to such a degree that the demand for semiconductors in whatever application it is meaning that there's a shortage, and semiconductor manufacturers just can't keep up. And so they've held up very well. So this is a key part of technology, but it had held up very much better than so many other parts of technology. And you can see we're after Thursday and Friday, we're almost back to basically all-time highs. So the semiconductor sector is one that I believe if investors are looking for diversification and exposure to the most robust sectors, then certainly semiconductors has to be in there. All right, let's just have a quick look at the VIX. So we'll just pan back. Let's go back 12 months on the VIX. And you can see we had some spikes. Obviously, we had a big spike back here in April and in March of 2020. We then settled down into a range between 20 and 26, 28, with the odd spike every now and again when the market got panicked. We had one in June of last year. We had another one in October. We had another little spike in January. But now the 20 level on the VIX has broken, and you can see it's trending down very sharply. So all of a sudden, people are not fearful and worried about the stock market. So these are all very, very positive signs. Okay, so let's start with the S&P. So you can see there it is, nice breakout on Friday night, been building up through the week, closed on its highs, 4,020 points. And, this is a terrific trend. There's just no other way to describe it. And the NASDAQ as a whole obviously had been weaker during the last few months as aggressive sectors were sold in favour of some of the returning sectors like financials and parts of industrials. But look, we finished the week quite well. We've now got higher highs and higher lows on a short-term view, so things are looking quite good. And seasonally, this is one of the better. April is one of the better months of the year for tech stocks if you look at the seasonality. Now, small caps, the Russell 2000 also copped a bit of a thrashing through the third week and into the fourth week of March. But you can see that turned around very nicely on Thursday and Friday of last week as well. Importantly, looking at the relative strengths, I'll just flick through. So this is the really key one. This is the relationship between growth and value. So the Russell 1000 growth stocks divided by the value stocks. When the line is rising, growth is outperforming. We flattened off in September through to December, and then we had a breakdown which occurred in at the end of February. So what that breakdown means is that the rotation from growth stocks to value stocks really gained momentum in late February. We were in some sort of balance prior to that, but we then got a very sharp rotation. But now that appears to have stabilised. It's stabilised about where you would expect it to from these prior highs and lows, and the signs are looking quite positive. And the other really important relationship too is between consumer discretionary and consumer staples. Consumer staples had a little bit of a day in the sun when fear was at its greatest, but there is so much cash on the sideline. There is so much pent-up demand to spend around the world that consumer discretionary is always going to beat consumer staples in a buoyant economy. And so that appears to have stabilised and started turning up as well. So very positive signs all around for the market at the moment. Is the US dollar. We're clearly back in uptrend. We've got higher highs and higher lows, so there's really no argument about that. And the Australian dollar, of course, is feeling that impact, and it started going the other way. Now, if commodity prices remain strong, particularly iron ore, then that will help cushion any further decline in the Australian dollar. So we may not see the Australian dollar go down as much as the US dollar rises, but certainly the rising US dollar is going to impact on the gold, obviously precious metals prices, but to a degree on base metals prices as well. Okay, so that's the US market. Australian market, our dollar slightly weaker, finished under 76. Our index was basically flat for the week, not much happening there. But small caps throughout all the ups and downs have remained as buoyant as any part of the Australian market. And I think the best risk-adjusted returns are in the small caps. So for me, looking to go into recovery sectors that may have questionable growth and very likely headwinds in the future, these are the companies that are going to tend to be disrupted. I'm just going to stay where the growth is, and most of the time that's in small to medium stocks that have got a global niche, and their business and their revenues are going to continue to grow at very, very high rates. To me, that's where the safety is. Growth gives you safety, dividends and the hope that maybe you're in a defensive sector that might do okay. That to me is not the safe part of the market. And I think a lot of the higher dividend stocks, a lot of the traditional names, and I still get questions about these sort of stocks, that they'll prove to be traps over the longer term, because a lot of these stocks are going to be disrupted. So you just need to be, I guess, careful about not just falling in with conventional thinking. Conventional thinking is you have a diversified portfolio, you have a bit of this and a bit of that. Well, some of those sectors of the market, I think, going forward are just going to continue to be under pressure. And you've only got to look at something like the chart of Telstra to look at what can happen over very long periods of time to stocks that have got some headwinds. Turning now to precious metals, gold was pretty flat, lost $2 on the week. Silver fell a little bit further. But silver is still outperforming gold on a longer term view. Now, when we look at precious metal stocks, there was a nice tick up in GDX and GDXJ to end the week, but a lot of technical damage has been done there and needs to be repaired. So, the sector is not out of the woods by any stretch of the imagination. My view on precious metals is long-term precious metals will resume some sort of uptrend, but I'm also seeing plenty of scope for the precious metals prices to fall further before that happens, and it could be, look, it could take into next year before precious metal stocks do better. Now, I'm not saying it will, it might happen next month, but I wouldn't be expecting any short-term rebound in precious metals, not with the US dollar going up. So until that dynamic plays out, I think the sector is going to struggle a little bit. So let's take a look at some of those charts. So first of all, we'll look at the ASX 200 just for the record. So we're pretty flat, as you can see. Not really much has changed there over the last month or two. Silver price. So if you look at where it is in relation to the 200-day moving average, the red line, it's still moving up quite nicely. We're still pretty much hugging the 200-day, but that contrasts quite sharply with what we're seeing in gold. You can see gold price is well below the 200-day moving average. So quite a stark difference there between the two. And if we look at gold on a weekly chart, you can see we've come down to this 38.2% level, and that may prove to be the bottom, but I would not discount a possible move down to a 50% retracement, which gets you down into the 1560s, 1570s sort of area. That still could be on the horizon. And if we look at GDXJ, you can see nice rebound Thursday and Friday, but yeah, we've got a breakdown at the moment. We're still below the 50-day moving average. We really need to see a break back above the 50-day and above this peak here. So we need to get back into this trading range for gold stocks to be looking buoyant again. And if we look at some of the local Australian stocks, this is Newcrest on a weekly chart, just to give you a sense of the big picture. So this goes back to 2016. You can see here we formed a high in 2019, a low in March of 2020 when everything got sold. We recovered again in July of last year when things were running fairly well for the sector, but we've dropped away quite sharply in the case of Newcrest from $38 all the way down to under $24. And if you look at my favourite gold stock, which I think has proven itself over a decade to be without question the best gold stock in the world, in my view, because they just consistently deliver time after time after time. They exceed what they said they were going to do. But you can see of late, even Newcrest, even Northern Star has certainly suffered for whatever reason. That's a head scratcher for me with the merger with Saracen. But we're now back down to the 200-week moving average on Northern Star. But look, if you want to own gold for the longer term and you want to own a gold stock for the longer term, I can't find a better, more reliable long-term gold stock than Northern Star. I would suggest that these are probably not far off the lows, and as a long-term investment, it would probably be pretty useful from here. But of course, that is only just my observation, and this is general advice only. So you need to examine that as a potential against your own circumstances. Locally, the bubble is really, or the froth, if you like, is in the developers. That's where the price action is. Gold developers, gold explorers are where the gains are to be made. But they're very much trading vehicles. They're not, in my view, at this stage, they're not stocks that you want to be buying and holding for the long term, because there's a long way to go, and these sort of stocks go through a huge roller coaster of price action. And if you buy at the wrong time, you could be underwater for several years. But that's where the price gains are at the moment, and of course in some of the IPOs. Turning to other commodities, copper slipped a bit because of the currency, 397, and nickel managed to be flat, but it had been a bit weaker than copper leading into last week. Crude oil slipped a bit further down to 60.33, and as I said last week, I just find the fossil fuel energy sector is just such a confusing mix of transient factors, things that are only going to be impacting for a shorter period of time, and all the geopolitical forces that are at play here. This is not a natural market, so I find it a very, very difficult market to gain confidence in. There's the spot copper chart, so we managed to level off, and there's the nickel chart. So wrapping it up, here we are 1 year on from the bottom of the crash, from the event that I guess changed everybody's lives and still is changing everybody's lives with border restrictions and the like. With the benefit of hindsight, March 2020 lows were one of the best buying opportunities of a lifetime. It was incredibly difficult to do that at the time. It really was, because it was so much uncertainty, came so quickly, and we had no idea how it would play out. I don't think there's been an event like this in the history of the stock market ever before, because it was not on the horizon. It just came out of nowhere. So it was incredibly difficult to be doing some large-scale buying at that stage. However, if you follow the charts and you put aside logic, personal feelings about what should be, and particularly the media, we started getting back into the market in April, tentative at the start, admittedly, cautiously, but we did start moving back into the market in early April. And that was really on the strength of the charts. It's not because I had any expectation about how the recovery would happen. I certainly had no idea that the stock market would get to the levels that we're at now, 12 months on. But I've learned enough over the years to respect the charts. And if the prices are moving up, and they're moving up in such a way that it looks like it's going to be sustained, then you've just got to go with it, despite what you might think. So for me, I think we're in an environment where you can stack the odds in your favour by heavily overweighting the mega trend sectors. And everybody should know what those mega trend sectors are. This is where all the disruption is occurring. And if you apply that to a good risk management approach, where you're sensible and you're cautious about your entries, you take profits when it's appropriate to take profits according to your game plan, then I think we're still in a secular bull market. It's likely we're going to remain in this secular bull market for another decade at least, punctuated, granted, by probably at least a couple of cyclical bear markets. But the overall trend is going to the upside for a long, long period of time. So if you've got a good, sound risk management strategy, you should be able to do reasonably well out of what's coming. Portfolio analyst last week, I did certainly quite a bit on the accumulation distribution analysis, which can tell you quite a lot about institutional buying. And looking for strength in that indicator when prices are going down is a pretty productive thing to do. And we certainly identified some good opportunities last week. And the rest was about answering questions and also trade management, and trade management strategy is important. So that's it for this week. There's my website address, which has got more information, and my email address as well. So hopefully everyone's enjoying a safe and relaxing Easter, and I'll be back with you next Sunday. Cheers.